Let's bring in Tom Hancock. He's GMO's U.S. Quality ETF portfolio manager. And Tom, welcome. We had a guest a few moments ago tell us he's been using any rebounds to further reduce his exposure to equities and is a little worried about what he sees here. How do you feel?
Well, you have to be worried about equities given everything that's going on in the macro environment and given how well most equities have done over the last couple of years. I would say most is not all. I think there are a lot of pockets in the stock market that have been kind of left behind, and that's maybe where we're putting a little more incremental capital right now. I would also say for a lot of our more growth-oriented stocks, the bad news is really stuff that doesn't affect the long-term story. So if you're investing in AI, what matters is how big AI is going to be 3 years from now, not what tariffs are or recession is this year. So there might be some opportunities there.
Where do you think the biggest opportunities are right now? You know, and maybe valuation's a good way to come at this, maybe not. But some of these multiples are down. As I said, Google is around 16, 18 times. NVIDIA, what is it, around 20? I mean, where do you see those opportunities? How do you evaluate them?
Yeah. Well, in the AI space, actually, I think Broadcom is a very exciting place to be. It's probably not as much upside as NVIDIA if AI really plays out, but we see their exposure as being a lot safer because they're making custom chips for Alphabet and other companies that have a clear application, clear use case, clear profitability. They're also gaining share on the networking side, and AI is not the only thing they do. They have software, they have smartphone components. They're a very diversified company. If you get outside of artificial intelligence, healthcare is one of those areas I mentioned that have been kind of left behind and actually do have pretty good fundamental growth characteristics. United Health, one of our biggest positions, there's been a lot of negativity about the stock that we think, frankly, is overdone. There's been some reporting we think is pretty unfair and misleading. So that's one that, as the news cycle moves on, we think is going to be a pretty strong performer.
Thermo Fisher, J&J, those are a couple of others. Is that right?
Yeah, that's right. So Thermo Fisher, for example, think of it as a picks and shovels company for healthcare research, for biotech. There's a cyclical hangover post-COVID. Had a lot of policy news, whether funding cuts from NIH or RFK's potential policies. But we think that's short-term stuff. Long-term, we're seeing great innovation in the healthcare sector. We've obviously have GLP-1s, COVID vaccines going over a few years. There's a lot of good stuff to like there. I think ultimately the companies will profit from that.
I'm not hearing you say NVIDIA.
Mm-hmm. The trick with NVIDIA, I think it's very easy for people to say, oh, NVIDIA's at 25 times earnings. That's a floor. How can you not buy here? And the problem is I think those earnings are potentially very ephemeral. This is a stock whose revenue has doubled each of the last few years post ChatGPT coming out. And for that revenue to continue, their customers have to keep investing. And a pause from the hyperscalers, you could really see the fundamentals fall away underneath that stock. So while there's a lot of upside over the long term, any sort of short-term recessionary pullback, or for that matter, fundamental pullback, if people are disappointed about AI, would really, really hit that stock hard.
And quickly on Apple, are you sticking with it despite these delays now in its rollout of Siri, speaking of AI?
We are, yeah. I see that as just a matter of eventually it'll happen. Like, obviously not great to get something pushed back, but we don't think that's, for a company as steady and a great long-term compounder like Apple, we don't think you should get too alarmed about these short-term wiggles.